Welcome to Illuminati Silver. We tell you the truth about silver. Today is Wednesday, the 1st of July 2020. And on Monday, we produced a video entitled Bank Stress Test Concerns and Increasing Gold Investment Demand, where we highlighted that the Fed is increasingly concerned about banks being able to have sufficient capital to survive the current financial crisis, and that investors are moving towards gold as a safe haven asset class and a hedge against the downgrading of other assets, such as equity markets and, of course, the US dollar itself. Well, at that time, gold was standing at $1,773 and silver at $17.87. Now, at the time of producing this podcast, gold is currently $1,770. That's some $3 lower. And silver is at $18.03, some 16 cents higher. But the time, incidentally, is 2200 hours GMT plus 1. You see, earlier today, we saw gold actually touch $1,789 and silver $18.46, though both have fallen back since. Now, we were going to actually report on this sudden rise in silver, but when looking at both the technicals and what was happening in the marketplace, we did suspect, we weren't sure, but we did suspect that the silver price would fall back down below the $18 mark or hover around that sort of level. And so we actually sat on our hands, to be frank, and waited until this evening before actually reporting what has actually happened. And yes, silver has fallen back. Now, this does not mean it won't attempt another rally tomorrow, but it does actually place silver at or around the $18 level currently. Now, stock market's a little changed today, though marginally in positive territory, and the dollar index is a little over 97. So let's take a brief look at what actually happened to gold and silver today and try to make some sense of it. Now, gold was certainly aiming for that elusive but attractive level of $1,800, and silver was well on the way to hitting the top of our trading range of $1,850. However, the ADP employment report came out, announcing 2.37 million jobs for June, and the May figures were also upgraded. And both the Market Manufacturing Index and ISM Manufacturing Index showed an increase in June compared with May. Motor vehicle sales were also up at 13 million, compared with 12.2 million the previous month. So both gold and silver reacted negatively to this news, as risk appetite increased. We still have, of course, the non-farm payrolls tomorrow and associated data ahead of Friday's holiday in the United States, and we shall therefore witness the trend that is likely then to be carried into next week. So today we saw profit-taking in terms of gold, and silver was buoyed, though fell back in terms of a potential uptick in demand by the industrial sector should the economy continue with its improvement. Now we should bear in mind, and this is important, gold reached 8-year highs today, and many analysts are becoming excited about potential gold prices of $2,000 by the end of the year, though some are even predicting $3,000. We're not, but some are. But we won't mention the pumpers who are now even advocating $15,000. Yawn, yawn. Now, at this stage we wish to quote Przemysław Radomski, the CEO of Sunshine Profits, who is regularly published on a range of investment channels and sites. Now, this is what he published to FX Empire, Foreign Exchange Empire, today. Quote, summing up, gold is stealing the spotlight, trying to break above the $1,800 barrier and the November 2011 high. But it's unlikely to be able to confirm this move. Gold did end the previous month and quarter at exceptionally high level, but the monthly volume was low, and it was the only part of the precious metals market that showed this kind of strength. Silver is just a few dollars above its 2015 low and over $30 below its 2011 high, while miners are trying to get above their 2016 high, well below their 2011 high. Given the above and gold's looming reversals, I think that a big decline is in the cards for the entire precious metals sector." Unquote. Now that's an interesting quotation, not one we necessarily agree with, but it's always worthwhile looking or listening to those who perhaps take a very different view from the norm. Now, in addition, earlier today, as reported by Reuters, and we'll quote what Reuters has said, European Central Bank Chief Economist Philip Lane signalled a pause in policy action, arguing that a rebound is underway. Markets have stabilised, but that many months will be needed before there is clarity over the shape of the recovery. Facing the biggest European recession in living memory due to the coronavirus pandemic, the European Central Bank has already increased stimulus 3 times this year, providing unprecedented support for an economy that could shrink by close to 1/10 in 2020 and take another 2 years just to get back to its pre-crisis level. The ECB extended its emergency bond purchases until June 2021, and Lane said that while markets are already pricing in a further expansion of the scheme, the bank had given itself up to a year to reassess the situation. "We've done a lot. We have essentially this 1-year horizon," Lane, a Dublin-born former university professor, told Reuters in an interview this week. That 1-year horizon reflects that before we really know how able the European economy will be to recover from this shock. Lane added that the ECB's intervention, including €1 trillion worth of loans to banks at negative rates and substantial purchases of commercial paper, had stabilised markets since March, while banks remained very liquid. We mentioned earlier the stress tests, so that's an interesting comment. Although recent economic indicators from industry surveys to inflation data have exceeded forecasts and positive data could come for a long time, Lane sought to temper expectations, arguing that a good bounce now says little about the broader recovery, which is likely to be interrupted from time to time. Winter scenario is unclear. We're in for a long period where the data should be mostly positive, but these weeks of the initial bounce don't really provide a guide to what's going to happen in the winter. Now, Lane's comments are in contrast to the views of the Bank of England's chief economist, Andy Haldane, who said robust early data argued for a rapid V-shaped recovery and reduced downside risks. Lane, the architect of the ECB's crisis-fighting measures, also appeared to play down expectations that the ECB will soon include sub-investment grade corporate bonds in its asset purchase program, a topic discussed heavily among market analysts in the early phase of the crisis. Few companies have lost their investment grade rating, and with the initial pandemic-related crunch over and many government guarantees put in place, Lane does not anticipate an imminent wave of downgrades. To me, current ratings look like a reasonable balance. The data are not compelling to say there should be a lot more downgrades, he said. Now, although some are expecting Eurozone inflation to turn negative in the coming months on increasing slack and crashing oil prices, Lane said his base case was for very low but positive readings on the back of fiscal and monetary expansion. You see, the ECB targets inflation at just under 2% in the medium term, but has missed this for 7 consecutive years, despite record stimulus. Some argue that surging debt levels will make it impossible for the ECB to tighten policy in the future, as any rise in borrowing costs would raise debt sustainability concerns in places like Italy and threaten the euro itself. Lane dismissed such arguments, saying this is not, quote, unconditional truth, unquote, and high debt on its own does not prevent a rise in inflation, which is a key condition for the ECB to wind down stimulus. Quote, our forward guidance is full of exit strategies, but what is true is the only real way to prove this is through action, unquote. Lane further said the ECB does not target any particular spread levels between the yield of Eurozone members, and it is absolutely not into yield targeting, unquote. So what are we all really to make of this? Well, first of all, it's fair to say that opinions are divided amongst finance experts and economists. Some believe that this second wave of coronavirus is going to severely hamper economic growth. Others believe in certain areas that a V-shaped recovery is on the cards. Of course, we won't know until either event occurs. But one thing we have certainly analysed, and a solution we have come up with, or conclusion I should say, is that unemployment, whilst it's going to improve in terms of more employment, we cannot see any model whereby those levels will recover to those experienced pre the crisis within the next 2 years, maybe thereafter. And therefore one has to take into account the purchasing power of those individuals who once had a job and now will no longer have one, and what further government stimulus will be required, A, to look after those individuals, and B, to ensure that some form of GDP growth and domestic consumption continues apace. Because without domestic consumption or international demand, the rates of inflation that central banks are hoping for will simply not materialize. Not within the time frame, at least, that they are anticipating or attempting to evaluate and provide the necessary action to achieve. So, a Japan-type economy could indeed be on the cards. What do you think? Do share your thoughts. Are we going to see this fall in gold and silver prices that Radomski has predicted? Or are we going to see a continual rise up to this $2,000 level and beyond over the course of the next 6 months? Do share your thoughts, and meanwhile, thank you so much for listening. And if you haven't already done so, please subscribe to the channel and press the bell sign so that you're notified of our videos as and when they are published. We hope you have found this video interesting and informative, and if so, please give it a thumbs up and share it on social media. Please ensure that you have subscribed to our channel and press the bell sign so that you are notified of any future videos. Also, kindly visit our website at illuminatisilver.com, and if you haven't already done so, please subscribe either as a free or paying member for regular email updates and offers. Disclaimer: Illuminati Silver owners come from a background of banking, international wealth management and economics. Having now retired from these worlds, we are not qualified to give investment advice. Therefore, this and other productions must not be deemed to be giving such advice and merely represent the personal views of its owners.